Okay, let's dive in. We're tackling something today that can feel pretty huge, maybe a bit daunting. Choosing the right mutual funds for your financial path.
It really is like a whole universe out there, isn't it?
Yeah.
I mean, the number of choices is just, well, it's enough to make anyone feel a bit lost.
Totally.
So our mission here, kind of drawing from this great source, we found a YouTube transcript, How to Choose the Right Mutual Funds. I'll get it at part 6 from Value Vive. Well, it's about cutting through that noise.
Making it simpler.
Exactly. Finding those key things that help you feel confident, make informed choices. The video puts it nicely, using wealth management to make dreams happen.
Yeah, I liked that framing. It admits just staring at fund names isn't the way. You need a plan, a map. And the source starts us off with the basics, breaking down the main types. First up, equity mutual funds. The source uses this Hindi word, intidi, enthusiasm, like the height of flight.
That's a great image, the height of flight, because equity funds, well, they're mainly playing in the stock market.
Right.
Their main goal, capital appreciation, making your money grow over the long haul. If that's what you're after, over years, this is generally where you'd look.
And it gets more specific based on company size. You've got large caps, the big familiar names. We generally think of those as, well, safer bets, right?
Relatively safer, yes, within the equity space. They aim for more stable, sort of consistent returns. But then you shift gears to mid-cap and small-cap funds.
Okay.
Now, that's where the potential for, let's say, higher returns often lies. But, and it's a big but, there's usually more volatility.
Mm-hmm.
Smaller companies may be growing faster, but riskier too.
Makes sense. A different kind of ride. And to sort of balance that, the source mentions multi-cap and flexi-cap funds. These sound like they spread things out a bit more.
Exactly. They invest across different company sizes, large, mid, small. The idea is diversification right within the fund. Gives you a mix.
Mm.
And key point with flexi-cap is the manager has more freedom to shift between sizes based on how they see the market. That flexibility is important.
Okay. So if you're, say, younger, got time on your side, you can stomach some market swings, maybe those mid or small caps fit that no bad idea.
They certainly can. But the source is smart to add, they need patience and discipline. You can't panic, sell when things dip.
Right. Got to write it out. Okay, so that's the growth part. What about the safety net, the foundation?
That brings us to debt mutual funds. The video calls them the foundation, stability. These are really for folks who are maybe less focused on shooting the lights out with growth and more concerned about protecting their capital. Lower risk is the name of the game.
So where's the money actually going in these?
It's going into fixed income stuff. Think government bonds, corporate bonds, treasury bills, things like that. Essentially, you're lending money and you expect to get interest payments in your principal back.
And there are different flavors of debt funds, too, based on, like, how long the loans are for and the risk.
Correct. You've got liquid and ultra short-term funds, super short timelines, maybe days or months. Very low risk for money you need handy. Then you have short-term, medium-term, long-term funds. As the duration gets longer, they can be more sensitive to interest rate changes, which adds a layer of risk and potential return.
Okay.
The source also points out things like credit risk funds. These chase higher returns by lending to potentially less creditworthy companies. So, yeah, higher risk there. And gilt funds, which stick just to government securities, generally seen as very safe from default risk.
Got it. This feels like a much better fit if you know you need the money in, say, 1 to 3 years, like the source mentioned, maybe for a car down payment or saving for a specific trip.
Absolutely. When that deadline is closer, protecting what you have becomes paramount. Debt funds provide that stability.
Okay, so we have growth with equity, stability with debt. What if you're looking for, something in between?
That's the sweet spot for hybrid mutual funds. The source uses the word dedication, maybe defining that balance. They invest in both equity and debt.
And the main advantage there is diversification, I guess. Spreading the risk.
Precisely. You're not putting all your eggs in one basket. It smooths out the ride compared to being 100% in stocks or 100% in bonds. And the video notes the mix can vary a lot.
How so?
Well, you have balanced funds, maybe roughly 50-50 equity and debt. Then aggressive hybrid funds, which lean more towards equity, aiming for higher returns but taking on more risk. Conservative hybrid funds do the opposite, more debt. And there are even dynamic ones where the manager actively changes the mix based on market conditions.
That makes sense. The source seemed to suggest these are pretty good for people just starting out, maybe a bit nervous about stocks.
Yeah, it's a good entry point. You get some exposure to potential market growth, but with that debt cushion softening the blows, it kind of simplifies the whole asset allocation thing for you.
Okay, let's shift to some of the more specialized funds the video covered. Index funds described as the Kraya, the path to richness through simplicity.
Yes. Index funds are, well, they're a big deal. They don't try to be clever and pick winners. They just aim to track a specific market index, like the Nifty 50 or the Sensex here in India, or the S&P 500 internationally.
So they buy the stocks in the index.
Pretty much, yeah, in roughly the same proportions. The goal isn't to beat the market average, it's just to match it.
And the big hook is lower costs, right? Because there's less active management.
Exactly. Since a manager isn't constantly researching and trading stocks, the expense ratio, that yearly fee, tends to be much, much lower.
And those fees add up over time, or rather don't add up as much if they're lower.
It's a huge difference over the long term. Seriously, compounding works both ways. So index funds are great for straightforward, stable, long-term returns. They're transparent, simple. You just grow with the market.
Okay, now contrast that with sectoral and thematic funds. The source called these a focused approach, high potential.
Right, these are much more concentrated. Sectoral funds invest only in one specific industry, like banking, IT, pharma, you name it. Thematic funds are a bit broader, focusing on an idea or a trend, like, say, digital India or clean energy or ESG investing.
So if I'm really bullish on, I don't know, healthcare technology, a thematic fund might be the way to go.
It could be, if you have strong conviction and ideally some understanding of that theme. The potential for big returns is definitely there, if you guess right, and that sector or theme takes off.
But I imagine the risk is just as concentrated.
Oh, absolutely. There's very little diversification. If that one sector hits a rough patch, your whole investment suffers. The insight here is these are usually best as a smaller part of a bigger, well-diversified portfolio. Not your core holding, unless you really know what you're doing and can handle the risk.
Makes sense. Okay, thinking globally now. International funds, offering that global perspective, diversity of power.
Yeah, these basically let you invest in companies listed in other countries, the U.S., Europe, China, wherever. The source mentions getting exposure to giants like Apple or Google indirectly this way.
And the big plus is diversifying away from just your home market.
That's the key benefit. If the Indie market takes a downturn, maybe markets elsewhere are doing fine.
Yeah.
It adds another layer of diversification, helps smooth out returns. Could also be a hedge against local inflation or currency issues sometimes. It gives your portfolio a different kind of balance.
Are there specific risks with these, though? More complexity?
For sure. You've got risks from foreign market ups and downs, currency exchange rates swinging around, different regulations. It's not as simple as investing domestically.
Yeah.
So great for long-term diversification, but you need to be aware of those extra factors.
Got it. Then there are ETFs, exchange-traded funds, easy access, live trading. What's the deal here?
ETFs often behave a lot like index funds. Many of them track an index, aim for low costs. The main difference is how you buy and sell them.
How so?
They trade on stock exchanges all day long, just like individual stocks. You buy and sell them at market prices during trading hours. Regular mutual funds, you usually buy or sell directly from the fund company at the price calculated at the end of the day, the net asset value, or NAV.
Ah, so that trading flexibility is the key thing.
It really is.
Yeah.
Plus, they're generally very transparent, costs are often rock bottom, and you have that real-time pricing.
Mm-hmm.
The source suggests they're good if you like the idea of trading, but want the diversification of a fund instead of picking single stocks.
Okay. And one more category. Fund Fs, or funda funds. One fund, many opportunities. Sounds intriguing.
Yeah, it's pretty straightforward conceptually. A
Yep.
fund of funds is a mutual fund that invests, well, in other mutual funds.
Okay, so it doesn't buy stocks or bonds directly. It buys shares of other funds.
Exactly. Could be domestic funds, international funds, a mix. The benefit is instant diversification across maybe different fund managers, different strategies, different asset classes, all through one single investment.
Seems convenient. Any catches?
The main thing to watch, as the video hinted, is the cost. You might be paying fees within the funds it holds and a management fee for the FF itself, so potentially a double layer of fees. But for really broad, easy diversification, it's definitely an option people look at.
Wow, okay. That's quite the tour of the mutual fund landscape. It really drives home why folks feel overwhelmed. So you know the types. How do you actually choose? The source makes a really important point here. The first step isn't even looking at the funds, it's looking at yourself.
Yes, this is probably the most vital takeaway, what the video calls smart selection criteria, the first step to smart choice. It really hammers home that you have to do some self-analysis first. You can't just pick a fund because it sounds cool or has 5 stars or your neighbor likes it.
You need to figure out your situation first. Like, what's my goal for this money? How long do I actually plan to invest at the time horizon? And, maybe toughest of all, how much risk can I really handle without freaking out?
Exactly, the video prompts you. How long is this money tied up for? What happens if the market drops 20%? Will I panic? What am I actually saving for? It's not, as the source says, a fashion trend. It's a life decision, needs real thought, not just following the herd or chasing last year's returns.
Okay, so let's say I've done that homework. I have a clearer picture of my goals, timeline, risk tolerance. Now I can start looking at specific funds. What key things should I be checking out according to the video?
Right, so the first thing mentioned is fund manager experience. This is especially key for those actively managed funds where the manager is making the calls.
Makes sense. Their skill matters, so you look at their history, how they've done over time, especially through tricky market periods. Is their performance steady?
Exactly. A good experienced manager can make a difference in active funds, navigating risks, finding opportunities. Then, related to that, is past performance. The story of yesterday may be a hint of tomorrow.
We always hear that disclaimer. Past performance doesn't guarantee future results, but it's still useful information, right? The insight isn't just chasing the highest number from last year.
No, absolutely not. The video suggests looking at longer periods, 3, 5, even 10 years. But critically, don't just look at the return number. Look at the consistency. Was it a smooth ride or a roller coaster? And importantly, compare it. How did this fund do against its benchmark index? And how did it do against other similar funds, its peers? The insight is context. How did it perform relative to the market and its competition? And how much risk did it seem to take to get there?
Okay. And that brings us neatly to the expense ratio, the value of every drop, as the source puts it.
Yeah, this is crucial. It's the annual fee the fund charges you for managing your money. It seems like a small percentage, maybe 1% or 1.5%, sometimes less, sometimes more. But the insight is that percentage comes directly out of your investment return, year after year after year.
Compounding works against you with fees.
It really does. Over 10, 20, 30 years, even a small difference in fees can mean a huge difference in your final amount. So, all else being equal, lower fees are better. The video notes they tend to be lower for passive funds like index funds and maybe large caps, and often higher for actively managed funds, especially small caps, where there's more research involved.
Worth paying attention to those small numbers. Okay, what about risk management? Balancing courage and understanding.
Right. Investing always involves risk. Smart investing isn't about avoiding risk, it's about understanding and managing it. The video actually mentions a few specific metrics here.
Oh yeah, like what?
Things like standard deviation that tells you how much the fund's returns have bounced around its average. Higher number means more volatility. Then there's beta that measures how sensitive the fund is to the overall market movements. A beta over 1 suggests it's generally more volatile than market. Under 1, less volatile.
Okay, those measure the bumps.
Exactly. And then the Sharpe ratio, this one's really interesting. It tries to measure how much return you got for the amount of risk you took. The insight you get from looking at these numbers is this fund getting high returns just by taking massive risks? Or is it actually delivering decent returns relative to the level of risk it's taking? Generally, a higher Sharpe ratio is better, more bang for your risk buck, so to speak.
That's super helpful, putting those metrics into practical terms. And then the final, maybe most important point, matching the fund with your goal, finding a solution, not just buying an investment.
This ties it all back together, back to that initial self-analysis. The best fund on paper isn't the best fund for you if it doesn't fit your specific needs.
Right, like the examples in the video. If you're saving for your kid's college fund 15 years down the road, you can probably afford to take on the higher risk, higher potential growth of equity funds.
Exactly. But if you need money for a house down payment in just 2 years, forget high growth potential. You need stability. Debt funds are almost certainly the way to go. Retirement planning is another whole ballgame, maybe consistent SIPs, maybe hybrid funds, depends on how close you are.
It really all comes down to your life, your goals, your timeline.
Couldn't agree more.
And speaking of strategies like SIPs, the video also mentioned those practical tools for investing and, eventually, withdrawing money. SIP Systematic Investment Plan, the magic of discipline.
SIPs are just Well, foundational for most long-term investors, investing a fixed amount regularly, usually monthly. The beauty of it, the insight, is it takes the emotion and guesswork out of it. You stop trying to time the market.
Because you buy more units when prices are low and fewer when prices are high.
Exactly. It averages out your purchase cost over time, which is called rupee cost averaging. It enforces discipline. Plus, it harnesses the power of compounding small, regular investments really add up over decades.
Makes perfect sense.
The video also briefly touched on SWP, Systematic Withdrawal Plan. That's for taking money out regularly, maybe for income and retirement, and STP, Systematic Transfer Plan, for moving money gradually between funds, like maybe shifting from debt to equity slowly. The point is, these are tools to keep things structured and disciplined over your whole investment journey.
This whole deep dive, it really highlights that, yeah, the mutual fund world looks complicated from the outside, but once you understand your own needs and what these different tools are actually for, it becomes navigable.
It really does. The landscape is vast. But being aware, being informed, that's your edge. Don't just follow the crowd or chase returns. The video really pushes this idea of becoming an aware, responsible investor.
Because every fund is different, has its own approach, but more importantly, you are unique. Your situation, your goals, your comfort level with risk, that's what matters most.
Yeah, mutual funds aren't some magic wand. They're just tools. You need a solid plan. You need strategy. And as the source stresses, you need consistency and patience to see it through and build that future you want.
You know, the biggest takeaway for me isn't just about the potential money you can make. It's about that shift in thinking, right? Understanding how this works, taking control of your finances, choosing the right fund based on your knowledge and your needs. That's empowering. That feels like the real win here.
Absolutely. Making a smart, informed investment decision is a real step towards financial freedom down the road.
So the decision, as always, comes back to you, the listener. How will you take this understanding, this insight, and use it to move closer to your own version of freedom?